Hey, good morning. Good morning, good afternoon. Sorry, I don't know where my camera is. So today we're gonna have a no camera meeting. I think, but that should be okay. My face is not a pretty one to look at anyway, so you won't miss anything. We are here to talk about the markets, the stocks, and I think from that perspective, we're all good. Whether you can see me or not really doesn't matter. Okay, all right, let's get started, guys. Good afternoon to you as well, Shri. Uh, Shri, where are you joining from? If you don't mind sharing. Iowa. Wow. Thanks for joining. How did you find us? And if you want to talk, you can unmute yourself and talk. Okay. Right. Yep. Most of this is like just word of mouth, a friend of a friend of a friend. QuantumScape. Sam, what did you find in QuantumScape? Guys, we'll just warm up while others join. And let me just get my water bottle here. All right. Now I'm fully caffeinated. Water is here. All right, so let's get going. I see QuantumScape. I'll share my screen. That will be QS, QuantumScape. It rose 20. Oh, so it looks like it had earnings. I recall talking about QuantumScape 2 years ago. They were working on solid state batteries. And I think one of the tailwind was that they had partnership with one of I think was it maybe Volkswagen, but I haven't followed it since then. Again, I think let's look at in terms of what their earnings is. Are they making any money or not? I guess they are not. So right now, this is one of those high growth, unprofitable companies. So whatever pricing or the stock we are seeing is based probably on hope. But let's see what happened. Why did it jump so much? So toward 5-month high, EV battery maker looks to bring its first product to market. So looks like now from just an experiment, from just being a test, now we actually gonna get a product in the market. So that does justify this 24% jump after this announcement. I'll give it to them. Yeah, it's been up 145% since the start of a year. But if you look at its overall, since IPO, it's up 35%. Not bad. It came IPO through SPAC, if I remember correctly, in 2020 when there was SPAC mania, and up 35% in around 2.5 years is not bad at all. But depending on who, if if we were caught, if someone was caught in this mania of SPAC mania during 2021 to 2020, 2021, 2020 and 2021, oh, there's a lot more to catch up. Yeah, beast went up to all the way to what, 120, almost 120. So looks like now they have a real product which they will be launching in the market. So I guess we still have to prove the execution of it. Well, let me just see how their financials look like. So they really don't have much of income, etc. Understandable. Let's look at a quarterly. Yeah, almost no income. For obvious reasons, they don't have anything that they can currently sell in the market. So this is one of those rare income statements that you will see. There is no income on the top, right? Otherwise, in an income statement, the first line you will see is revenue. Then the next is cost of goods sold. Then you see a gross profit. In this company, there is no revenue, right? So, but let's look at how much money do they have. So where's balance sheet? Sorry. Yeah, they still have close to $1 billion. So I think, but they are burning almost 28% in a year. So they have close to $1 billion. And how much do they need? Operating expense and all that is amount to 123. Yeah, so they've got some decent runway. They're not gonna run out of money pretty soon. They have a decent runway. They got $1 billion, and they probably have at least 2 years of runway. So the fact that now QuantumScape can get a product out in the market, I think that just justify this huge jump of 23%. Yeah, 24% after earnings. But this week I saw a lot, many of the stocks posting good results, means the stock rose. Businesses were also doing fine, but I think that we should focus on how the business is doing, not really what happened to the stock. I mean, you could, but in the long term, what business does matters a lot more than what stock has done today, right? So what else? Other hot news on Rivian. What happened to Rivian? Rivian is one stock which I want to own, but again, not been able to pull a plug in terms of adding this sticker to my portfolio. Haven't done that yet. What happened on Rivian?
Sorry about that. Actually, I think Ty brought it up last week, but I thought of what he said. Maybe it's not the right time. You might have the perfect product, like say the Apple Newton, remember? But it's not the right time. We didn't have the bandwidth 30 years ago.
Yeah.
So Rivian still's owned 18% by Amazon.
Yeah. So that's what of all the companies, let's say Rivian, Lucid, Nikola, what other? After Tesla, if any other big EV company, only company, not like Ford and GM. If I'm bullish on or Fisker, right? Of these four, if I'm bullish on anyone, it would be Rivian because of the partnership with Amazon. And number two, I see a lot more Rivian trucks around me, right? So this is similar as boots on the ground research. You go and see what's selling more. I see a lot more Rivian trucks. I think Lucid, sometimes I will see Lucid, but Lucid sold very few cars. So yeah, Rivian partnership with Amazon, and number two, that they are executing is a good signal. But I haven't really looked at in terms of how many cars they sold, how are they doing it, because I don't own in my portfolio, so I haven't spent much time on Rivian though. Hey, all right. So today, what are we going to talk about today? Yeah, we're going to look at some of the other EV stocks, not from US, but in China. The market over there has it heat up over the last week, and we want to talk about that. And of course, big earnings coming, earnings coming from these big mega techs, Meta, Alphabet, Microsoft, and then a couple of other earnings we want to look at, right? And as always, we also look at a little bit of a macro. I'm not a big fan of macro, but I think it because no one can accurately predict what's gonna happen in micro, but it makes sense to be little aware of macro. So we look at the macro and any other questions that you may have. I see a comment. Lucid dealership in my neighborhood last week saw a new office building close to completion. Science parks all over SFO. Right. All right. Let's jump on to session. Before that, I want to thank you all for making this community stronger. Now we have 1,000 members. I know few joined every week, but good to see. What we started almost, I guess, 3 years ago. It was the middle of pandemic. Me and a couple of my friends were interested in talking about stocks, anything else. I had been in the markets for a few years before that, but then we were looking for a forum to talk about options. That's why we started initially with just options. But then I realized talking only options doesn't make sense if we don't have a good foundation of understanding stocks. So we also pivoted to stocks, right? So, and of course, now we talk about stocks, options, bonds, ETFs, treasuries, cryptos. I think, except the nitty-gritties of real estate, I think everything that probably we can buy or sell on exchanges, I'm open for discussion. So what we've been meeting every weekend, and plus doing some boot camp in the middle, look at markets, earnings, IPOs, deep dives, and today's 183 session, right? So I hope to continue. Hopefully you'll continue to join and enjoy these, and let's learn together and earn together. Right? Individual learning is boring, so with the team it becomes much better to learn and grow. So thank you for the time, for your investment. 2.5 hours investment is, it's not trivial. So I appreciate you guys showing up weekend and sharing your time with me, and I hope to share my content and what I see in the markets. Let's make it more interactive. Cool. Next, I also want to thank, I don't want to name people, but I also want to thank someone. This came from the tweet that I mentioned about the books. So as you guys know, I am fond of reading books, especially around any subject, but mostly given the time scarcity that I have, I'll focus only on the business related books. So I saw another tweet saying, hey, I need to increase my book budget for the next month. And lo and behold, this community is great. And one of you sent me a gift card for my book budget. So really, really appreciate the gesture. You didn't have to do it, but the fact you did, after looking at the tweet, I'm gonna go and get a couple of books from here, and we'll share what we learned from that book. So that really touched me. Someone reading this tweet and reaching out and sending a gift my way, saying, hey, for your book budget, really appreciate. Thank you. Thanks a lot. So now the question is, which book are you interested in? Which one is the next one that I should pick up? I have 2 on my out of these 10 two which I have on my list is one is from Terry Smith, which is this one, Investing for Growth. This one, Investing for Growth. This other one is Expectations Investing. Third one is Outsiders. I've heard some good things about these books. If you don't have any specific recommendation, I'll pick up based on whatever I feel that day, right? Maybe I'll start with Investing with Growth and then Expectations Investing. Cool. All right. So now continuing, or before we jump onto the stocks and all that stuff, little bit food for our mind. Continuing the previous book, which I've been reading, is How to Invest. Some words of wisdom from the chapter 2. Chapter 2, David Rubenstein, his interviews Ron Barron, who's a CEO and founder of Barron Capital. And this is one of the few funds which, not even just match, but it actually beat the indices, right? If you really look at 80% of the mutual funds, they don't even meet their indices because of the cost structure and all that stuff. But Barron Capital funds are few, those who do beat the indices by almost 500 basis points on an average, right, since 1982. Its technique is to look at the businesses with strong franchises and solid management, with the management having meaningful ownership stake, and buy their stock and hold it forever. Right? This is a lot more Buffett's kind of an investor. Focus on long-term trends in tech. Right. He was an early investor in Tesla and SpaceX. So one thing which I found is some of these mutual funds, and maybe there is a fund that exists out there in the world, which could allow you to take exposure to a group of, privately held companies. Right? So if you want to, let's say, invest in SpaceX or Databricks, Instacart, these are all privately owned companies, not in public right now. So there are two ways to do it. Either you can go to those secondary markets where some of the employees are selling their shares, but then they have some minimum requirement of, let's say, 25K per investment and all that stuff. Or maybe we can look at some of the funds, because some fund like Barron Capital, they are also invested in SpaceX. I don't know if you are interested in that, may want to look into, is there any fund which does specific investments only on the private companies? It says, I use Instacart for my purchases. I like the service and the platform. There is growth. Yeah, but I guess it's super expensive though, but it's convenient. And when you need it, I mean, you can get it. But only worry that I have, Rash, in around this Instacart or any kind of those delivery services, is there is generally no moat. And unless you are delivering anything, this is a very low margin business. The margin is just continue to go down on this one, right? And that's the reason why right now, I think every delivery service is trying to become everything. Right? So look at DoorDash, started with just food delivery, then becomes grocery delivery. And I guess if you ask DoorDash, maybe, I don't know whether do it now or not, but probably you ask them to pick up something from Target, they might pick up something from Target. That's my only worry about these delivery companies, is it's a cutthroat business. It's a low margin business. I really don't care who delivers the goods at my place, whether it's coming from Instacart, DoorDash, Postmates, Uber Eats. All I care is I want it at the cheapest price. So in this business model, it's difficult to survive unless you have a large volume, right? So my only play in this is Uber, because I mean they have a multiple businesses. So that's my take on Instacart. Probably a good, great company, so far survived on VC capital, but it's a tough business to make money on. Right? There is no differentiation, right? It's a commodity product. Delivering food or delivering goods is commoditized. So I don't see any moat on Instacart, unless, I mean, I haven't done analysis on Instacart, but just looking at the business, all they do is just delivery. I can answer what's the moat that they have. So yeah, enjoy the promotional driven marketing. I mean, that's what it's a volume business. Whoever has the biggest volume will probably capture the market. And right now, they probably are spending a lot to on promotional marketing to get more and more customers. The question here is, how long can they continue to bleed before they start to make any money? Right? So probably good service may not be a good stock for now. Okay, what else Ron Barron has to say? I lost confidence in market predictions from watching Alan Greenspan describe irrational exuberance in 1996 that caused market to be too high, and the market went up 80% for the next 3 years. Right? Same common theme I see again and again among the, I would say, top-notch investors is, come on, don't even try to predict the market. No one can. No one has been able to. Everyone tries to be. Only people I think who are able to predict the market are the YouTubers or TikTokers. I think the great investors, those who have made some real money, their take, almost all of them, their take is, don't try to predict the market. No one can predict at the macro level what's going to happen, where it's going to go. Right? Next one, on making mistake. I give up. When I say I give up, means I give up on a stock because we make a mistake on the business or the person, not because the stock doesn't perform. I think this is really very important to differentiate between the stock and the business. Right? At any given point of a time, stock could be going up or down. I think the most important thing is to look at where is business going. Right? And if the business is still chugging along nicely and the stock is not, you may still want to, I think that's probably time to maybe add on to the stock, because the business is going fine and the stock, it's like a good business, bad stock. I want to add good business, bad stocks to my portfolio and would want to trim good stock, bad businesses from my portfolio. Right? So yeah, if you make a mistake on the business, admit it, move on. Looks like Ron Barron and their fund, they don't want traders in their funds. So if you invest in and sell within 3 months of a purchase, we will regard you as a trader, and then you are not going to be allowed to buy with us anymore. That was an interesting take. Here's one mutual fund which says, sorry, if you want to invest with us, minimum is 3 months. You can't like buy and then, hey, I'm going to sell it in a week or two. With availability of all these, trading tools available on our cell phones, the holding period has been coming down and down. Right? Nowadays, the expectations is if I invested in the stock in the morning, people want that stock to perform by the end of a day. Right? That's not how the big money is made anyway. So, but these gadgets exist. I think last week it was a Larry Fink's interview, right, where he said the Wall Street is all about not really making money, but facilitating the trades. And that's where we have all these tools to facilitate the trades, which entice us to do more transactions than focusing on the business. Finally, on market predictions, I've been doing this for 52 years, and in the entire period, I've never seen anyone consistently and accurately predict what the economy or the stock market is going to do. No one, not Warren Buffett, not Elon Musk, not my friend Peter Lynch, certainly not me. most investors try to predict what I believe you can predict: interest rates, oil prices, wars, elections, outcomes. Very, very true. Like I said, only people that I find that can predict, those exist in FinTwit or on YouTube. I'm not on TikTok, but I guess those people exist on TikToks as well. Dave say, what's more exciting over 300 plus points in NASDAQ futures this week is the UFO congressional hearing. Yeah, I haven't followed up, Dave. I haven't followed up on the UFO stuff, but I guess, I mean, it's been almost a decade since I read the book of Area 51. And after reading that book, I kind of had no doubt in my mind that US has a lot more secrets, especially our Pentagon and the CIA has a lot more secrets than we know about it. And so, yeah, if now some UFO stuff is coming out, some alien spaceships, or maybe an alien body, wouldn't be surprised. Rese, what about meme stocks phenomena during pandemic? I'm not question what about that? So yeah, one thing we know is, how it panned out. So who says? I think it's Warren Buffett or Charlie Munger. One of them said, right? In the short term, market is voting machine. In the long term, the market is weighing machine. Right? So eventually your valuation will come down to what your business is. In a short term, yeah, a lot of meme stocks did great, and then they all came back to earth. Now all of those stocks are being repriced. Okay. Now, and these things over the last 10 years, I think when you have a zero cost of capital, then it becomes, the line get blurred between good business and the bad business, good stock of a good business, performance of stock of good business, and performance of a stock of not a good business, because the cost of capital is zero. You could borrow. When I say you, means individual investors as well as the funds could borrow the capital at a very less cost, and then can pick up any share. Really doesn't matter whether how good the business is, because your cost is very less. Now with the costs going higher, cost of capital going higher, I think now the investors have become wiser to the fact that we'll have to really pick up the stocks that's got good businesses, right? So maybe the stock picking may come back in vogue in maybe in the next decade, when the cost of capital is not going to be near zero, right? When the cost is near zero, there is no differentiation between the good investor and a bad investor, or a sleepy investor, or investor who has done no homework, right? Because there is no cost. So any return is a great return. But now that the market may be changing. Shri says, still have short calls on GME, which I sold when meme stock at high. Yep. If you had sold the short calls, depending on when you sold it, probably you're sitting at some nice decent gains. So congratulations. If I were you, I generally don't want to hold naked short calls on these meme stocks, because again, short term, anything could happen. And even if you're right, again, that depends on how big your account is and what's your margin requirements for the account. But even if you're right on the direction of the stock, but if you're holding a naked calls, your brokerage may still want to close out your position, especially in these meme stocks, before you could enjoy any gains. So me personally, I am not really comfortable in holding naked short calls on any of the meme stocks. But yeah, everyone's comfort level is different. I don't want to lose sleep when I'm investing. So I want to sleep well, and don't have to worry about what my portfolio is doing. And if I'm holding short calls, especially in the stocks like say GME or AMC, what's happening to these AMCs, right? Where is GME? Let's see how much is the short interest. Because these things could blow up again. Reddit, the power of social media, one lesson that 2020 and 2021 has told us is, if individual investors decide to band together, they can actually move the market. Right? They won't be able to move the business of the company, but in a short term, they can move the stock prices. And that's what we saw in 2020 and 2021. Now the GME, short is it's not that heavily shorted. Now it's maybe just 20%, close to 20%. So that's not bad. And at some part of a time, this was like 450. Why did it split? I recall GME had hit 300 plus during this. Why it doesn't show that? Maybe it was a intraday, but still it should show me the candle. Something probably wrong here, because I do recall that GME had hit those numbers. And similarly AMC, right? And AMC CEO is trying all the tricks in the books, ape preferred shares, and now trying to do the merger and all that stuff. But yeah, all those things have come back crashing down. A lot of meme stocks have came back to earth. Now they are being repriced based on how the business is doing. Dave, the stock market is big balance sheet. What goes up must come down. So I'm looking for the out to happen soon, at least down another 2 points. Yeah, so a little different. I'm not sure that what goes up has to come down. I think volatility is one area where I agree that generally comes back. It's a comebacks to normal. When it comes to the price, I mean, if business continue to do good, the stock could continue to rise. Yeah, I do agree that stock going up 40% when we see no change in the business, yeah, that might come down. But mean reversion in the stock price, at least I'm not a big fan of that. Of course, if it is egregiously priced, that's a different one. But in a normal course of business, and I know, some investors, they do talk about mean reversion when it comes to the price. I'm fan of mean reversion in the volatility, right? Or your implied volatility of a stock, but not really mean reversion on the price. She said, my short is covered by a small long position. Oh, so that's your kind of a covered call. So, yeah, covered call, I agree. I mean, being a big fan of covered call, probably share one more example today. So yeah, to now, I think over the last 2 weeks, some of those little bit of that meme stuff seems to be coming back to the market, right? Again, I haven't been looking at these meme stocks, so really don't know in terms of has there been any substantial change in the business. We looked at QuantumScape, I think at the start of the session, that really actually had I agree this 23% high, that it deserved it because now looks like they have a product that they can bring it to the market. Right? But still, I still feel it is a risky unless that product is in the market and is succeeding, right? It's it's coming out from the lab. And this is a company with the technology, not really a product that they can sell, and currently valued at what, 6.3 billion. But if this really works out, who knows? This could change the whole EV scenario. But I would rather be now. I think now that they have an execution risk, probably they are beyond the technical risk, but they still have to execute. All right, continuing on, macro side, yeah, this was a week of Dow. I think it was up not 14 days, probably 13 days in a row. And then last time it did 14 times or 15 times was in 1897. So we didn't break that record. I think and we saw Dow, I think after 13 continuous updates, it stopped for a rest. Anyway, so we had FOMC meeting, and after FOMC meeting, we saw market was up nicely. It closed nice, for the end of the week. Again, there are three areas, not going to go in detail. Really doesn't matter for the long term, but I think it helps to know what's happening in the market. Market thinks that the Fed is now nearing the end of the rate hikes, probably one more, right? Or probably market is not, I don't think market is pricing in any more rate hike, right? They're saying, hey, Fed is done. Now we'll keep it as steady. Whatever is 5.5, we're going to keep it at 5.5, and maybe next year we should start to see some rate cuts. Inflation continues to abate. The numbers that we saw was like 2.9% from 9% last year to 2.9%. And the growth still seems to be resilient. So these three are helping the market to go high. Meeting was nothing burger, nothing changed. I think that was as per expectations. 25 basis point hike. Fed fund rate is now 5.5%. That makes it, again, equity risk premium to be even lower. And next meeting is on September 20th. So 2 more CPIs and the job reports will be coming. And as always, Mr. Powell says, will be data driven. I mean, all his speech are almost the same. So I don't know why there is so much of anticipation or anxiety around what Jerome Powell is going to say, because he almost says the same thing over and over in every speech. We're going to be data dependent. We'll see what the CPI numbers are, how the job numbers are, how economy behaves before we take our next decision. So I didn't find it anything different. Dave Asher, okay, Sri said GME was split 4:1. Okay, that's a reason. That's the reason. I didn't know that. Thanks. Dave Asher. Sorry, someone is want to say something. Okay. Let me just bring up that chart. What does this tells us? S&P 500 trades at 20x PE in aggregate with 17x, removing the top 7 stocks. Yeah, so I think I have something, maybe a similar information. Mega cap tech versus the rest of S&P. So mega cap is 32x, and the rest of the S&P is 17x. But I think over the last 1 or 2 weeks, the rest has started to catch up, so which is good. But yeah, these magnificent 7 has been driving most of the gains in S&P for this year. See another one. EPS. Yeah, this is exactly what we're referring to, is that the earnings expectations has come down, but the stock and the market is still going up. That is why I'm still being cautious and holding my short calls, naked calls in some of these the tech indices. Even though so far those haven't worked out, obviously, because QQQ continues to go high, NDX continues to go high, but that's okay. The rest of the portfolio is benefiting, but I'm not willing to go and increase a lot of deltas in my portfolio just yet. I think it was the last week or a week before that where we also saw a comparison between the earnings change and how the stock prices have changed. There's a wide gap between these two. So Eventually, either the earnings catch up to the stock price, or the stock price will fall and catch up to the reality of the earnings, right? So at this point of a time, it's where the difference between, I mean, the market is already priced in a lot of a perfect execution from the companies, and if you are anything less than perfect, markets kind of will punish in the near future. So yep. But now the fact is that there have been a lot of investors, including institutional investors, who have been sitting on the sidelines, because at the start of 2023, the main theme in the market was a recession is coming. Fed has been increasing interest rate. So be cautious, right? And that's what the Mark Wilson, the best analyst of 2022, he was regarded as the best analyst in the street for correctly predicting 2022. He finally threw in the towel, right? So his prediction was that the market is too overvalued, and we should come back and see the lows of October in 2023, which is what, 350. SPY at 350 is a low of October. Let me just bring that up. And just this week, Mark Wilson, he threw in the towel saying, hey, we were wrong. Which is, yeah, around this. Oh, this is pi. I'm looking at, yeah, around 340 at 350. So, and maybe some of those fund managers, they are coming back and say, gosh, we missed out that whole rally, and now deploying the capital. Maybe that is pushing the stock price higher. FOMO. So it's best to, what I say, it's time to be fearful when others are greedy, right? So I'm being cautious. And I have been cautious for almost now 2 months. And I am still cautious about the market. That doesn't mean I'm gonna, sell the market or sell the positions. That's like trying to time, which I can't. I don't think anyone can time the market, but just that you scale your positions up or down, you scale your investment up or down, you scale your deltas in your portfolio up or down based on what do you think the market's gonna do, right? Again, so that's I've been cautious. I'm still maintaining and continue to roll my short calls from one expiration to another, so as to just keep the deltas in check. So S&P 500 is up almost 20% for the year. QQQ is up 45%. Of course, QQQ was beaten really bad last year, so it still hasn't recovered completely. Almost, I would say it has recovered, but 45% for a year. And imagine if Morgan Stanley's investor, because Mike Wilson is from Morgan Stanley, and if they had told their investors, their big funds, customers, saying, don't put any money in the market, don't do dollar cost averaging for 2023, they had lost what, 20% upside so far this year. And that doesn't bode really well if you are a portfolio manager and advising your clients. So maybe we probably start to see some FOMO in the market. So this is looking at the various sectors of S&P 500. So like I said, S&P is almost 20%, right? And then we got, so S&P is 20%. The best performing is communication services, or IT or communication services, almost 45%. The worst ones are utilities. So this is utility, and then this is energy. So if, I think energy had a good this week, but other than that, these are still negative for this year. Everyone is now gone back into some of those beaten down sectors of 2022. The sectors that performed well in 2022, like energy, this year, so far it hasn't. So this rotation will continue. So if you are a retail investor, we don't want to do sector specific, buy and hold and reduce cost basis on S&P 500. Perfectly, good strategy for retail investors. Unless you want to dig deeper and want to go and do a sector specific investments. So when there is less fear in the markets, the so-called dividend paying stable companies, not really the growth companies, they don't do well. So energy, financials, utilities haven't done that great this year. What has worked so far this year are discretionary, like Teslas, and of course the tech and the communication sector. But just this month, we did see, a little bit broadening of a market, which is good to see, right? Because so far, most of the gains have been driven by those magnificent seven. So if those come back down to earth, you would see the markets retracing. But this month in July, we saw those sectors that hasn't yet performed so far till June, those coming back and picking up, right? The sectors that we talked about earlier, right? Utility, energy is up 5% for the year. So now we are seeing a little bit of a broadening in the market, which I feel is a healthy sign. Just those top seven or the very narrow band of stocks continue to go higher and higher. That makes me a little scary. But seeing little more variety means the stocks that haven't performed so far, or the sectors that haven't performed so far, now they are coming and catching up. That's a little more, I would say, positive sign to see. I see a comment. I'm kind of surprised about communication gain when AT&T, Nokia, Ericsson, and Verizon are on a downtrend. Now, you'll be surprised to see what is in communications. So Facebook is considered in a communication sector, right? So I think S&P, they did this little bit of a change when the Facebook was moved from, I know at least of Facebook, because I distinctly remember when this sector shuffling was done, and that point of a time they said Facebook is moved out from tech sector into the communication sector. So there are not just the real communication companies which are in the communication sector. Some of these social media companies are also part of this communication sector. And that's the reason why we see a communication sector. So this year has done well. So it's always, I would advise, if you are picking sector specific ETF, I haven't picked up or invested in this year, at least the communication ETF. Communication sector ETF from, I think, Spiders. They should have some XLC. So let's look at what is XLC, or look at the top holdings of XLC. Meta Platforms. Oh, even Alphabet is in communication sector. Activision Blizzard. Then talk about Comcast, T-Mobile, Charter. Netflix is in. Verizon, Walt Disney. So the word communication has changed its meaning. So that's the reason. So if you are interested it's always you should look at what the holdings are of the particular company. If you're before you want to invest in ETF, now the names really sometimes doesn't make sense because the meanings of those names have changed. And now with these companies in the portfolio, Meta is like 25%. So if you look at Meta, Alphabet, they make almost 50% of the portfolio. So no wonder XLC is probably performing so well. So how is XLC done? Year to date. Oh, come on. One, 6, 26 year to date is 40%. Right. Yeah, so the names could be misleading. So there are a lot more charts. I don't want to, probably we can come back to it, but there's some more interesting charts. I saw it in a Yardeni performance research report, 2023 sectors, what works, what is not working. If you're interested, you could just Google for it, Yardeni research. The report came out like yesterday. Okay. If time permits, maybe we can come back to this later. So where are the values now? Magnificent stocks. Earlier, Dave has shared another chart which shows that the valuations are already stretched too high. So magnificent stock. This is from Bloomberg. I think different firms have a different way of measuring it, but the theme is the same, right? 30x valuation for Magnificent 7. Overall, S&P is around 18, 19. And the rest of the companies, it's close to 17. If you take out those 7, the rest of it is still, I wouldn't say 17 is cheap, especially when the earnings are being revised downwards, but way better than 28 or 30. So maybe the rest of the sectors now look cheaper as compared to those tech and the communication. And if we see any cracks in the market, probably money could flow back to those safe sectors, consumer staples, utilities, energy, financials, which kind of also provide a little more dividend. So that's probably the values outside of these 7 is not as stretched. So if we are looking to bring an additional capital, again, not a financial advice, but there is still, it's not that the overall market is overvalued. The whole market is not overvalued. There are some sectors which are still available at normal valuation. I wouldn't say this is cheap valuation, 16, but normal. Yield curve continues to stay inverted. We'll see how it happens. PE ratio, overall market is still higher. We just talked about it. And fear and greed index still in the firmly on the greed side. What's coming up next week? I think there's a lot of companies that I'm interested in are reporting results next week. So let's see which ones are gonna have special focus on. Uber. What I'll be watching in Uber is to again see how the ridership is doing and the split between the Uber Eats riders and what happened to the logistics business, because earlier they were going big in logistics. Then I think they're looking to sell the logistics. So do want to look at Uber. I'm still bullish on Uber. What else? To Pinterest, with all these, with Meta doing what it had done, is there a more tailwind behind Pinterest with a new CEO and with more focus on their e-commerce? I'm surprised of why they are not able to capitalize on the fact that everyone goes to the Pinterest with an intent to buy, right? And they haven't been able to provide an easy way to convert that intent into action. We'll have to see, what happens on the Pinterest side. What else? Of course, PayPal. We did a deep dive into PayPal a few months ago, I guess. And so I found PayPal valuation to be very compelling. So I added to my position. I just want to see how, what they come up with. Number two, how far they have reached in their CEO search. Shopify, bellwether also for Amazon. What else? Mercado Libre, it's on my top 10 position, top 5 positions. Obviously, every quarter want to see what they have done. Would like to see how they manage their risk on the credit side. And of course, the general is their e-commerce and the payment volume. Payment volume has been growing like crazy over the past few years. So that's a big tailwind behind it. Valuation so far seems to be decent. So want to keep an eye on that one. See, she says Etsy. What else? Of course, this comes other big taxes, Amazon and Apple. Block, Airbnb. There are a lot of, I see both bullish as well as bearish things around Airbnb, given the state of real estate market. But I'm still bullish on this one, on Airbnb. What else? No. So these, Arista, when is Arista reporting the results? I haven't followed Arista over, I would say, last 18 months or so. They had one big customer concentration issue with Meta. I don't know how, have they diversified their customer base? If they have, that's great. But I think that was one concern which I had on Arista, was huge customer concentration risk. But I'm talking about maybe 18 months ago. AMD is bellwether company. So yesterday saw some nice tweet around AMD. Right now there's a battle going on between AMD and NVIDIA around the chip side. And the tweet was nice, saying, let's keep all the chips in the house, right? Something to that sort. Because looks like the AMD CEO, Lisa Su, and the NVIDIA CEO, Jensen Huang, they're actually related. They're relatives of, so Jensen Huang, I think he's uncle of Lisa Su. So doesn't really matter whether it's AMD who wins or whether it's NVIDIA who that wins. The chip's gonna come back to home. So that was a little funny tweet. Okay. Cisco is the king. Where is Cisco? When is Cisco reporting? They're not reporting. I think, but that's the comment with respect to, I guess, Arista. Yeah, but isn't it Cisco that they still have to? They haven't yet gone back to their .com high. Cisco Systems. No, so I feel about this is a problem, right? If somebody would have given into FOMO and had invested in Cisco in 2000, after 23 years of wait, they haven't yet made any money. So this is where, for a retail investor, I think it's unless you know about the company or unless you know how to reduce the risk, investing in individual company is, even though the company, Cisco is not bad, but just that it got caught over in this whole .com mania in 2000. If you take this portion out, 2000, 2001 out, it's been a great run for the company. So, but because it's what since start is 130,000%. But if you had invested and got caught into the FOMO, it's a tough situation to be in. So, Arista CEO worked at Cisco. Is it Jayashree? Is he the CEO of Arista? Yeah, Jayashree. Okay. Yeah. Oh, yeah. She was in Cisco. Good, but good to see Cisco, trying to close that gap of 23 years. It is almost there. No, I think that the peak was 80. So they still have some more to catch up. So this is where I think the same thing we could see would apply to those meme stocks or the stock mania that we saw in 2020, 2021, that if you had bought at the peak of those individual stocks, right? And we always talk about it, the stock may be cheaper because it's still 30% down, it's still 70% down from its previous all-time high, whereas the rest of the stocks have caught up. So I think this stock probably will catch up, right? But it may be a long wait before it catches up. Now the valuations have started to matter. And I think I hope, to be very frank, I have a couple of stocks that I hold in my portfolio. But good thing is that we use options to continuously reduce the cost basis. So I may not have to wait 23 years to recover the money, right? So that's why it's important to learn and to know how to reduce the cost basis so that we are not only dependent on the stock performance. There is something we can get back from the market through option premium. All right, so it's going to be really, really interesting next week, I would say. A lot more earnings to talk about, I guess. So what did I buy or sell this week? Again, this is not a financial advice. Just want to be transparent because we talk about stocks. So I bought some SCHD, which is I think I have a chart later on. Oh, why I'm picking SCHD over some of the others. Dividend plays, we talked about a lot of dividend plays a few weeks ago. And I hold SCHD already in my portfolio, but over the last, I think, 1-2 weeks, started to add a lot more, just from the fact that so far those dividend paying stocks haven't performed, right? Utilities that haven't performed. If you look at all the money that was going to the growth companies, so I don't want to invest any more in QQQ right now. And from my perspective, I think it's too much too soon. Again, I could be wrong. No one can predict the market. So if I were to invest, I would rather invest on a sum of, when there is any correction in the market, we might see, rotation back into those safer companies. Now, I haven't done any individual analysis of the companies. So if I have not done or analyzed an individual company, my preferred route is to go through an ETF, right? So if you look at this, it's still where it had started 2023, right? So companies like, let's look at the holdings of this SCHD holdings list. I guess like companies like Home Depot, all these good dividend paying companies are the major holdings of this. So that's why I bought SCHD. EWJ is a Japanese ETF. Shouldn't be surprised. Our previous week session was go East, go Japan. We talked in detail of why Japan. So now I'm putting my money where my mouth was, literally, because I was talking about Japan. So picked up some Japan and added a little more to the Palantir position. Sold XLV, which is healthcare. Again, this is an ETF. I hold J&J in my portfolio. So I have a decent healthcare position exposure. But again, haven't studied much on the healthcare side and rolled that money into SCHD. Right? No big logic or algorithm to why did I sell XLV. I wanted to buy SCHD, and then I looked at which in my portfolio I understand the least, which is XLV. I have a healthcare exposure already, so recycle it. So that's on buys and sells. Okay, we'll come to the earnings, but before that, an interesting chart I saw was, I didn't know about this, but it looks like all the companies came from the same grandparent, which was Standard Oil, J.D. Rockefeller. And interesting to see that how that Standard Oil was split by the government into different companies, and then got renamed, merged, eventually, Chevron, ExxonMobil, BP, Marathon Petroleum, they're all offsprings of the same big Standard Oil. Isn't that interesting? Came from the same family. If Standard Oil was not split, probably that would have been the most valuable company on earth. That's an interesting one. The other thing is, now we are seeing a lot of growth stocks performing well. A good tweet from Beth Kindig is around the levels of stock-based compensation. So let's say, wow, things that not surprised, things like this is Matterport. I see a lot of retail investors getting excited into this. This is, I guess, Sound, which is AI play. I'm not sure I would call it the AI play, but I would say, let's say AI meme, right? They don't really have the real AI tech, right? But hey, when it's AI, everything goes up. And then I see on Twitter, a lot of retail investors talking about SoundHound. What? Of all the AI plays, all you look at SoundHound. 92% of the revenue is being paid out as a stock-based compensation to the employees. Right? Hood, 48%. Is that crazy? So I don't. Confluent, 47%. So these are the, almost 50% and more than 50%. I don't even know what is NVTS is. MTTR is Matterport. What is NVTS? NVTS. If you own any of these companies, right, and you're seeing that, okay, they actually generate some cash flow and all that, please do the cash flow after reducing the stock-based compensation, because they are just putting, I would say, they're just hiding the, or little, I don't want to use the word called deceptive, because it is legally allowed, but the fact that you're paying 40-50% of the revenue in stock-based compensation to your employees, and that doesn't show up as a cash drain, and hence keep your cash flow positive, I'd say, or not even positive, but cash flow in a healthy position. You need to normalize the cash flow after reducing the stock-based compensation. So she asked, where can you see stock-based compensation? You can see in their cash flow statement, right? So let's pick up Hood. That's where it helps, that when you're looking at the earnings, you go through that financial statement. So Robinhood, investor relations. Hood has to quarterly results. So they have done Q1, right? So let's pick up this. Combined statement of cash flows. Here we go. So share-based compensation is $220 million for the 3 months ended March 31st, right? And their overall, their operating cash flow is $437 million. So out of 437 million, 220, more than half is coming from share-based compensation. So now let's look at the revenue. How much revenue did they make? So total, they made 218. So total net revenue is, let me go to the income statement. Consolidated statement of operations. Yeah, $300 million was the revenue. Oops, sorry. Looked at the wrong one. 441 million is the revenue. And out of that, did I pick up the wrong one for the stock-based compensation? So $440 million, let's remember that as the revenue. And out of that, shit. Wow. I'm really looking at the right stuff. 598 million is a share-based compensation. So that is as of last quarter. Oh, that's crazy. Yeah, total net revenue is 441, out of which, and they're given, that's more than 100%. Or maybe the bets is that maybe an annual one. I don't know, but this is where you can find your share-based compensation, SBC. It's in your cash flow statement. Twilio, I don't know, Twilio, let's look at Twilio investor relations, financials, earning release, quarterly filings Q1. So let's look at first of all, let's look at their income statement, statement of operations. I think one request I would have for SEC is also to standardize the format, saying whether you're going to show the latest year first and then the previous year, or the previous year first and the latest year. Now we just saw two reports. Robinhood reports 2023 on the right side and 2022 on the left side, and the Twilio is reporting it differently. Can we have a standard format? Otherwise, one could get confused. So they have Twilio has overall revenue of close to $1 billion, right? And then if you look at their cash flows, stock-based compensation, including restructuring, is $170 million. At least in this particular quarter, that wasn't that bad. Yeah, you could use stock analysis as well. Only thing is the stock analysis is they don't have the data updated on the same day when the results are out. It lags by a couple of days. So if we want the latest one, so I use stock analysis. I mean, I shared that earlier. But let's say when the Meta had reported results and I went to stock analysis, they did not have Meta results. It took them 2 days before it get updated. But yeah, for anything, they got a nice data around your cash flow statements, a lot of ratios, and that's what I use. But yeah, keep an eye on so-called free cash flow. Always normalize the free cash flow after reducing the stock-based compensation to make a decision. Right? So a lot of companies hide behind stock-based compensation to artificially jack up the free cash flow, and that's something we have to watch out for. All right, this week was a great week for Chinese stocks. Right, look at XPeng or Zhang. I really don't know how is that called. Some of my friends, if you can help me, the company name is XPENG, but I've heard it's called XPeng or it's called Zhang with P being silent. I really don't know. So my apologies if I'm butchering the name. I'll probably call it XPeng unless someone corrects me and say, hey, you're wrong. It's called Zhang. So anyway, this is an EV maker. I hold it in my portfolio. It is a wild run. It was up 60% in a week. Right? So it's called XPeng. Okay, that's fine. So I've not been committing huge mistake because I heard in some podcast, some host calling it Zhang. So I wasn't really sure, it's called XPeng or it's called Zhang. So thank you, Sam. So the main reason behind XPeng going up 60% in a week was a Volkswagen investing $700 million, and which basically Volkswagen has taken 5% stake. They're gonna also collaborate in tech. Also, it will develop 2 Volkswagen branded EVs. Basically, we'll do it for Volkswagen, right? And it's going to be a new partnership. Investors are betting that it will be lucrative for XPeng and will also help them to expand in Europe, right? So great. This company has done 60% in a week, but how has it performed since its inception? 2%. Right? Not over whenever it came public. It came public in 2020, I guess. And of course, it rode the whole 2020 mania, 2021, and then came back crashing down. And over the last, I would say, 2 weeks, the whole tailwinds on the Chinese companies, and specifically the news about Volkswagen investing $700 million, that has pushed the company prices up 60%. But then even including that 60%, it is barely even, when it had started, right? It's just up 2.63%. Rest says Volkswagen investment, they changed the direction at whim. 60% is artificially inflated. Yes, I don't know, right? So I already sold. I've been selling premium on this beast for whenever I started initiating my positions, right? So I had a covered call at 16. Now that that will get called away. I mean, that's August 18 expiration. After it jumped to 19, I sold another one at 22.5, I guess. What do they have? They have 22.5. Yeah, 16 and 22, right? And then, on Friday, it's up to 23. That's fine. But we got to do what's the right thing to do, right? And this is what I again want to share. We talked about one on Disney last week, right? So far, my transaction price of stock is $17.28. Stock is at 23, right? Which is great. Hey, from $17, right now the stock is 23. That gives me what, around 35% gain, right? 35-40% gain. But because of the premium selling, my current cost basis it doesn't pay any dividend, right? So there is no way for me, if either I just buy and hold, which is generally you'll do if you don't do options. My preferred method is buy, reduce cost basis, and hold, right? So over the last 3 years, actually 2021 is when it started, right? So since 2021, that's when it came IPO. I already reduced my cost basis by almost $5, right? So now with $12.70, this is almost what 80 plus profit. So I'm okay if it gets called away at 2022, right? It's fine. I bought it at 12, not bought it at 12. I bought it at 17.28, reduced my cost basis to 12 by selling premium over last 2 years. And if it gets called away at 2022, that's almost 85-90% return on my cost basis. And like we've talked about our last couple of sessions, it's only a partial, the covered call is only on a partial holdings that I hold in my portfolio. So the rest of the holdings will continue to do good. So I'm not getting into the foam and say, hey, either buying it, I just got to do what we got to do, right? There are few stocks that I have entrusted to my coffee can portfolio. So I will continue to do the covered call on the remaining of the stock. So if those get called away, that's perfectly fine. The coffee can portfolio will benefit a lot more, right? So I know some people have reservation around, hey, we're going to give up the upside gains, right? But then do only a portion or do a call spread, right? So thinking through the coffee can portfolio ever since we discussed it has made me realize, like, look at a portfolio. I looked at all the holdings in my portfolio, identified how much of those holdings I want to put in a coffee can, put that in a coffee can, put a tight lid, and then I put a padlock on it. I'm like, these I'm going to keep come rain, shine, storm, tornado. And the others, I'm going to use it to continuously reduce the cost basis. So that's the game. I say a comment, will you sell put at 22.5? It gets called. Yes, I will. Right. So I have one covered call, which is active on 16. And when it went to 20, I already sold a put. So that now I have a iron fly at 16. And then I have a call at 22, right? Short call at 22. If it gets called away at 22, fine. I will then go back and sell a put again. You learn, in my previous life, I tried to defend the call and not get it called away. And then, share crash and took a loss in buying back the call, but didn't sell the shares. And then the stock crashed. So we are still learning. So this time I'm like, no, I'm going to keep some of the shares in a coffee can and let the other shares get called away. And don't be greedy about it. So that's XPEV. Again, shows the power of selling option premium. And this is what, 3 years, right? The stock came IPO in 2021. And if you look at that, it's almost 30% forcefully return. I forced them, not the force. There's no dividend. So that's the only way for me to get any return on my investment is by selling premium. So this is what provides you what everyone says is margin of safety, right? There are different ways to get margin of safety. If you look at a Warren Buffett, he will know what the CEO probably will eat for breakfast, right? He understands the company so well. He understands the management so well. I don't have that capability to do it. So I try to build my margin of safety by reducing the cost basis. So another one is NEO, right? the same stuff, it's up 33% for a week. Again, I didn't find anything specific news for NIO as a company, but there's a general news around China. We talked about it maybe last week or a week before that, is that the Chinese government is becoming more open to help private sector. But now coming to specifically the EV companies, is the Chinese government agency announced that they will bring private, capital to major public clean energy and transportation projects, right? So now this and companies like NIO, and probably I think some of it's also given for XPEV, they are benefiting from that tailwind of Chinese government investing in it. So now NIO also got $740 million investment from Abu Dhabi Group, so which may help them in growing in Middle East. So if you recall in the previous quarterly results, they talked about their expansion in Europe. Now they got another $740 million for CVYN, which could help them in expanding in Middle East. So again, I'm a happy shareholder of NIO. I don't have to worry about where NIO goes. Third is Baba. Baba was up 10%. Again, no specific news, but I think the fact that the Chinese government is, I would say, loosening or relaxing a little bit its grip on the private enterprises also bode well for Baba. So overall, I think, and if you look at what the Chinese ETF did, maybe we can have a quick look at that. Oh, this one. One sec, let me just bring up the Chinese ETF KWeb. Oh, this is a tech ETF. Yeah, that's up, what, 7%. FXI, the bigger large cap China ETF, was up 5.5%. Sam says Kramer pump suggests only Alibaba on Chinese stock. Oh, I didn't know that. Maybe inverse Kramer. Anyway, yeah, so I didn't follow that. Kramer was talking about Alibaba. The third one, it's not a Chinese stock, but again, making news, is Palantir. Now another analyst, Dan Ives of Wedbush Security, pretty well respected analyst, though it had a little bit of a murky past. We want to dig into that, but Street still respect him, and he came back, told that Palantir has built an AI fortress that is unmatched, and the stock is set to soar 54% as a new industrial revolution begins. Right? So his price target is $25 per share, which is 54% higher than where Palantir is tracking right now. If you look at PLTR, is around 17 bucks. Something. It was up almost $11. It's around 17.81. So his price target is 25. A little late in catching up. We've been talking about Palantir since February, I guess. So if you did initiate a position, congratulations. The stock has done pretty well this year. Again, the question is not whether the stock, but I think the business has also done well, and the stock is just following the business. Again, Palantir will report. Oh, even I think Palantir, isn't Palantir going to report next week? Did I miss that? Because that's another one which I want to watch to see how their commercial revenue and what's their AIP platform going to do. That will be my focus whenever Palantir reports the earnings. I thought it was next week, but probably may not be. So now I think the Street is catching up on its AIP platform, which is their AI specific. And of course, they have a different products, like they got Apollo, they got a Gotham, and now AIP. So what else he has to say? As we begin the fourth industrial revolution, Palantir is engaging in widespread trend of various industries, leveraging recent generative AI innovations, blah, 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 a lot of big words. Sees the next 6 to 12 months as a period of significant expansion. Yeah. Oh, I think maybe they're just catching up with what has already happened. They found out, oh, we were late in recognizing this. And now they come back with a higher price target. So I'm still, I will continue to be a holder of this, but I find this price target is ridiculous. But the market can go to, to those levels. Who cares? It's $25. If I look at the just evaluation, it means is free cash flow need to grow 45% for the next 10 years. If you look at a, discounted cash flow model, right? But there are different valuation mechanisms. One valuation mechanism could just be looking at total addressable market, which is for now for AI looks to be an infinite, right? Any company talking of generative AI, it looks like it's an infinite market. And on that hope, this stock could go to 25. I'm not saying that it won't go to 25. I find it really, I would say it's a ridiculous price target, but there have been times when the stocks will go to ridiculously high price target and will continue to move beyond that, right? So, but generally they may not be able to perform if you buy at, let's say, 25 or 20, at those ridiculously high prices, it may underperform the market for next 5 to 10 years. So I find, I'm not complaining because I hold a bunch of Palantir stock, but I find it very unreasonable to have a price target of 25. Or it reports on August 7th. Yeah, so it's not next week, then it's week after that. Okay, so we'll see how much is the traction, and may very well, after that quarter result, this may not seem to be an unachievable target. If suddenly we find that the traction in their AIP platform and is huge, and number two, if they have grown their commercial revenue, if they've blown those numbers out of the water, $25 may seem to be reasonable. This is based on the last year's cash flow numbers, right? But things have changed. So I'll be watching this and see what Palantirs bring up in the next quarter. So, okay, finally around SCHD, as I told you earlier about SCHD, why? Again, this has got a strong portfolio metrics. If you really look at return on equity, is 38.17%. Earnings growth is 15%. Price to earning is, I would say, safe, right? Less than 14. So that's the reason. And it has got more than 3% dividend yield. So while many of these big techs and the QQQs are at ridiculous valuation, if I were to find some, place for the new capital, that's why I picked up SCHD. It is optionable with decent liquidity. I find a decent risk reward with 13 PE and nice dividend yield over 3%. And it has beaten the market over last decade. JEPQ has been increasing in value this year. JEP has been stable all year between this QYLD. So we looked at all these JEPQ, JEPY, QYLD. I think they got a good dividend yield, but then you don't have a capital appreciation. Because I think all the three are doing covered calls, right? One of them is doing covered calls on QQQ. The and I don't know now which one was which. Probably QYLD is on QQQ, and the others are on SPY. So while their dividend yield is great, I think one of them is almost 10%, right? But then you don't have a capital appreciation. So let's look at JEPI. So JEPI, if you look at, yeah, it started its year around 54, still sticking to 55. And JEPI is the tech, or is it a SPY? I forgot. We talked about all these three when we were looking at this dividend investing, including NOBL, SCHD, PQ. Oh, this is a JEPI maybe, then SPY, JEPQ maybe tech. So started at 41 to 49. It's at what, 20% capital appreciation. Because obviously, if you keep selling covered call, and then you make a decent income from covered call, but you lose out on that capital appreciation. That's why you have to take a decision on how much portion of your portfolio do you want to sell covered call. There is no free lunch. Covered call reduces the risk, but also will cap your upside gains to a certain extent. Right. So yeah, so I've been picking SCHD. So building more position on SCHD. Not a financial advice, but I had it and I like it. The fact that if markets are tough, these stable dividend ETFs fall less than the market. And also when the markets are ripping higher in the growth side, it also grows less than the market. Now, depending on what's your, as an investor, getting the highest return is not the only target. You might find it a little surprising, but the truth is, as an investor, my goal is not to get the highest return. My goal is to, and your goal, as well as everyone's goal, should be to get the return in a way that you have a money when you need it. Getting 50% return on the next 5 years has got no value for you if you need the money next year, right? So based on that, you have to adjust what your portfolio should be. So anyway, now let's talk about earnings. Let me sip some water. We'll spend maybe 30 minutes going through some earnings, unless someone has some questions. A JEPQ has been increasing in value this, sorry. I joined late. Did we talk about Google? No, we will talk about Alphabet. Yeah, we will talk about earnings. Any other stocks that you found in this good week that you're happy that you're holding that stock in your portfolio? Because so far this year the markets have done decently well. 20%, almost 20% in SPY. What else do we want? On an average, it is what they say, 10%. That's already done twice of its average. There is nothing to complain about the markets this year. All right. So let's talk about earnings. The first one upon plate is Microsoft. Revenue increased 8% to $56 billion, which is better than expected. Operating income was up 18%. Net income is up 20%. which is great. So 20 billion, so $56 billion of revenue and $20 billion of net income. That's almost close to 40%, little less than 40% net profit margin, which is great for a company which is as big as Microsoft, right? Diluted EPS was 2.69. Again, great, 21% increase, which was better than expected. So Microsoft, they report the results into three bigger segments. One is called productivity and business processes. I'll not go into the details, except let's say picked in the LinkedIn revenue was up only 5%. That's not that great. Intelligent cloud, there's the other segment in which I think all eyes are on, hey, how are you doing with Azure? It does include Azure and some other stuff, but largely driven by Azure. And Azure, it grew by 26%. No longer growing by 50% that it used to grow, but 26% not bad at all. It's now the base is bigger. So they grew by 26%. The business area that did not perform that great is the personal computing, right? Windows, this includes the Windows stuff, the devices, like their tablets, Microsoft Surface tablet. I haven't heard about Surface in the last 1 year. So that hasn't doing that great. Hopefully, with Activision Blizzard, maybe I don't know if they're going to add it under this more personal computing. We'll see that, but that overall revenue decreased by 4%, and the return $9.7 billion to shareholders in form of share purchases and the dividends. So market really didn't like it, and if I recall, Microsoft actually closed lower. Yeah, it was down 4% after reporting the results. So overall summary, revenue and earning was better than expected, but the stock was down because the guidance for their next quarter, that wasn't that great. Street was expecting $55 billion of guidance from Microsoft, but they gave $700 million less. Number two, they came back and told that we're gonna do more investments in building capabilities for AI. So little less revenue than what the street was expecting. More investments means less free cash flow to be returned or to do anything else. Market, yeah, we don't like you. They punish the stock. This is what happens, right? I don't see anything wrong in the results or in the guidance. I mean, if you have to be the leader on AI, you better put those investments, right? Better make sure you have the best infrastructure, even if it comes at a cost of the, let's say, lower operating margins or lower net margins for the next quarter, right? That's an investment you got to do. So better do that. So this week, this quarter, so they have a $19 billion of free cash flow. In this quarter, overall $60 billion free cash flow for trailing 12 months. Their margins are 30% free cash flow margin, which is great. So I think they can afford to spend some money and building AI capability. So I think this is just small, not small, I would say this is a short-term overreaction from the market, but I don't know what Mr. Market will do, and I don't control that, but I'll still continue to hold my shares and, sell option premiums. Azure is continue to grow as a nice space, not as fast as what it used to be, because now it has got a higher base, but 26% is still okay. And combine it, if they can build these capabilities for AI, they can see a lot more tailwinds from the use of, the demand for their generative AI from the customers. So that's in nutshell Microsoft. Sometimes post-earnings stock reactions can be crazy. It's just I would say a small short-term knee-jerk reaction. What's the rationale of owning LinkedIn low margin product? I don't know if it's a low margin product. They let me pull up. Do the report? I don't think they report margins on each of these business segments, though. Hold on, let me just pull up. Oh, this is Microsoft. Let's see if they. Responded to they got so LinkedIn revenue, they do report a revenue was up, and even if you look at the overall operating margin, right, it is 43%. So I'm not sure that the LinkedIn is a low margin business. Let me see if they don't report the margins specifically on LinkedIn, but even if it is, it really didn't matter because overall they're still hitting 43% operating margin, which is good for such a big company. Bank buyback will suffer since they'll be required to hold higher balance due to bank failure. Yeah, there is new regulations that have been proposed. I don't know if they've become the law yet. Maybe I didn't capture, but I did hear about a new regulations around the banks is to hold more capital specifically for bigger banks. Oh, so not yet. Okay. Specifically for bigger banks. So to me, it looks like this, like bigger will gonna become bigger, right? The big ones are gonna become bigger, will become biggest now. And they're gonna just eat up the small ones. So I don't know. I don't like that. There should have been poor competition, but that's the reality right now. So that's on Microsoft. I see a couple of comments. RH, which I guess is Restoration Hardware, and SHW is like Sherwin-Williams. What is SHW? SHW, yeah, Sherwin-Williams. Home builders stock are going up. Yeah, so these, because the only homes that are selling are the I guess the new homes. So the existing home sales, the existing owners, they're not moving because who wants to leave the 3% mortgage rate or 2% mortgage rate and take a 7% mortgage rate? So the new home sales are happening, and the existing homes, people are just sitting tight over there. And that's why you're right, the home builder stocks have done well, which if generally we look at saying 7% mortgage rate, not good for home builders, but I think the first time home buyer or the new homes, those are working because the existing homeowners, they are not moving. So Sherwin-Williams, $2 billion of income, $22 billion of sales, so 10% net profit margin. For P27, that seems to be a little high, and they have been reducing their share count. And do they show dividend yield here? Oh yeah, okay, just tad less than 1% of a dividend yield. So that's on Microsoft. Let's come to Meta. Meta, just we had a good quarter. We continue to see strong engagement across our apps, which is their family of apps. WhatsApp. I mean, of course, the main flagship app is Facebook. I don't know if I should call that as a flagship, or nor Insta is a flagship one. But in any case, they got a Facebook, they got Instagram, and then the WhatsApp. These are the three main ones. They got Reels to compete with TikTok, and then latest one was Threads. I don't know what happened to Threads. They got 100 million users, but looks like they are falling off from an activity perspective. So anyway, so the revenue increased. So they had a overall revenue increase by 11%. Not that great. But cost was almost 10%. Overall cost was 10%. Operating margin was 29%. Right? So from a revenue perspective, we didn't see a huge jump in the revenue, but the stock jumped really high. Right? Stock was up, I think 7%. At some point of a time, it was up 8-9% before it closed a little lower. But still, after the earnings, I think this had Meta. Yeah, it had up around 4.4%. Right? So the market still rewarded it. Now, looking at some of the numbers, daily active people is 3.7 billion, or if you look at a monthly wise, is 3.88 billion. So they got half of the world population on their platform already. Going forward, it's difficult to imagine that they can continue to increase the users on their platform. Right? If you look at the users, they grew only 7%. So the only way to increase the revenue is to extract more from the users that you already have in your platform. At this point of time, I would think that they are kind of saturating the overall people that they can attract onto their platform. They got half of the world. So the increase in number of users could still be single digit. Revenue, we talked about that increase 11%. They repurchased 793 million of the stock. What's good, what Street liked is headcount decrease, and this is what they have been emphasizing for past couple of quarters, right? That we're gonna be efficiency. We're gonna be more efficient in our operations, and they're gonna pursue greater efficiency. Same commentary came again, and that's what market liked. So if in this particular quarter, they also had to take this one-time restructuring charge of 705 million and 1.64 billion on family of apps, and then another, I would say, 350 million on Reality Labs. So if you add all these, that becomes close to $2.3 billion of restructuring charges. And now this is just one-time charge, right? For all the people that they had to let go and the restructuring that they had to do. So if we exclude this one-time charge from this balance, from this expense, operating margin, so you add another reduce 2.3 billion, that becomes 7 billion. So operating margin will be close to what, 40%, like 40-45%. So I think that's what Street liked, is that, hey, this is a one-time cost that they had to take, and if they continue to focus and work as efficiently as they've done in this quarter, is going to be a 40-45% operating margin business, right? Which is great. So that's the reason I think the market liked it. Number two is that they are able to, I think I do have yeah, let's look at the charts then. They are able to generate more revenue as compared to the previous quarter. Right? So if you look at their family average revenue per person is 8.32 as compared to 7.91. And this has happened across all geos, not just, one particular area, but across all geos. They were all higher as compared to the last year. So this does give a hint that advertising is picking up, right? So they are able to extract more from the users as compared to what they were able to do Q2 in 2022. And that's the reason, streak lighting. Other thing to notice is while Zuckerberg is continuing to cut flab at other places, he's still very, very serious about investing in Reality Labs. So they made what, $276 million in Reality Labs, and their operating loss this quarter is around $4 billion. So if we look at annualize it, that's almost $20 billion loss for Reality Labs. $20 billion. So he's still focused intently on building the metaverse or whatever the Reality Lab will come up with. And so other side of the business is doing great, but if you're not comfortable with this, Meta spending close to $20 billion, give or take $18 to $20 billion in building metaverse, which you don't think is the future, then you may want to rethink your investments or your positions in Meta, right? While they'll be becoming more efficient, they're gonna change the mix of the people that they hire, and in that case, they're gonna get more technical. They're gonna increase more technical roles in the company, right? To focus more on AI. So those are great tailwinds behind this is AI, advertising. The short-term headwind will be the operating losses that they will continue to incur for their investments that is going into Reality Labs. So something to watch out for as a shareholder. But I'm not complaining, still continue to hold Meta. Net income up nicely to $7.7 billion. So overall summary is half of the world is on Meta apps. Yeah, if we take out one-time restructuring, not restructuring cost, restructuring cost, the operating margin would have been 44%. So that's a great leverage. And yeah, I think we talked about it all others. So that's Meta. Any other things you found on Meta or you're interested to know about? So, Zuckerberg's idea is one day we will all be in metaverse, and that's the world that he wants to own. And if that means we're going to lose $10-20 billion, so be it. But if this his vision of reality doesn't pan out, then we'll have to think about it for it in the long term. But currently, that's what he's focused on. All right, quickly, let's get to Ford. So Ford had increased the revenue to $45 billion, right? So we'll come back to the numbers maybe later. I think we generally haven't spent much time on talking about Ford, but at a high level, they report their business into three segments: Ford Blue, Ford Model E, and Ford Pro. So Ford Blue is their gas and hybrid, products. People love those products, passionate about it. The most selling vehicle in the US, F-150, Bronco, Mustang. Model E is where you got all your EV stuff, right? Your Mac E, probably, I guess, F-150 Lightning. E will be part of everything which is E, including the software, hardware, architecture. That's all comes out of Model E. Ford Pro is integrated vehicle hardware, software, servicing, charging, finances, everything else come out of Ford Pro. So these are the three big segments under which Ford reports its results, right? Overall revenue is up 12%, nicely. EBIT is up 2% to $3.8 billion, and most of that 3.8, surprised to see that majority of that is coming from Ford Pro. I mean, equal amount, Ford Pro and Ford Blue. Obviously, Model E, they're not making any margins. I mean, Elon is squeezing them when it comes to the margins for the EVs. Adjusted free cash flow, $2.9 billion. So I think that's fine. Good cash flow. Overall, $45 billion. Then I was looking at its numbers. Is how much of a revenue have they generated from their EVs? That's like $1.8 billion. Overall, 34,000 units sold. Okay. In last quarter, Tesla sold what, 456,000 vehicles, which is more than 11x of what Ford has done. But Tesla's overall revenue is only $25 billion, whereas Ford has got $45 billion. So while I was going through it, I was reminded that that Ford is in a similar situation what Microsoft was during the period of, let's say 10 years ago. When the cloud was coming up, Amazon was investing in cloud, but majority of the revenue for Microsoft was still coming from their Windows licensing and all that stuff, maybe 15 years ago. Okay. And the previous CEO, Steve Ballmer, he didn't want to, he didn't want the team to take focus off from Windows because that was a current cash flow. And the result was that kind of a Microsoft started to lose relevance in the new world, wherein you have software delivery through cloud, right? No more desktop, no more getting CDs and installing it. So good thing is we had Satya took over as a CEO and pivoted the whole business. But it is difficult to not feed the cow that is currently giving you milk, because maybe you want to feed some hogs that you can use later on for the meat. But it's a difficult decision that they have to make. Ford Blue is getting $25 billion of revenue, which is the same revenue what Tesla is bringing in to their EVs. Right? Now, their EV side, they're only bringing in what, close to $2 billion. Now, it's a difficult decision. I hope the CEO is doing the right stuff, but a company has such a decision, you have to take you have to decide to, if you have to invest amount of money, where you want to invest. Are you going to invest in the cow that is giving us milk, or do you want to invest in the future? So I do want to see, maybe I need to dig a little more deeper into what is Ford doing. Are they doing more investments on their EV side of the house, or they are protecting their existing turf? Because protecting the existing turf just won't work out. The world is changing, and this existing gasoline or ICE engine vehicles, the market will continue to shrink. So you could still be a king, but in a shrinking market. I would rather have Ford try to play in a market which may become bigger and bigger. Yeah, hybrid may be a response to the Tesla dominance. Sure, we have to see in terms of Ford Blue, how much is coming from hybrid versus the full ICE. I didn't see that breakup over there. But net is, I was thinking they are in the same situation what Microsoft used to be. And it's a difficult decision for the CEOs to make, because you're talking about making a decision which will impact 10 years later, 15 years later, long-term decision. And CEO, like, I won't be even around there, right? Why would I not starve my current cash flow to invest in an area for which I may not be able to, see those benefits? But good CEOs do the stuff for the long term. So we'll see what Ford does. They have Explorer and F-150 hybrids. Yes. Next is Intel. Not too much details on Intel. Only thing we need to be aware of Intel is they are back to profitability after 2 quarters of losses. But I guess there's still a long way to go through it. The thing that market liked about Intel was cost cutting. Right? So there are still some headwinds, which could be because companies have a limited amount of budget. And this year, if you're not talking about AI, not investing in AI, the market is going to punish you. So many of the companies, they are now using the dollars that they have to spend on AI chips, not really onto the data center chips, which is where Intel is very strong. It's not strong on the AI, not yet. Right? NVIDIA is the king on when it comes to the AI. So if you have to, as a CIO, Chief Information Officer, if I were to allocate budget to spend on AI or on the regular data center chips, today everything is going to AI. So that expense may be cutting, the spending on the data center chips. But Intel has been, they slashed their dividend by 65%. They cut the base pay for CEO. They did a layoffs. They restructured their manufacturing. And now they're also becoming, fabrication plant for other companies, right? Till now, Intel only used to create chips for themselves, but they have also decided to become and play in the same area as TSM does, as Samsung does. Right? But the fact that they were back in profitability after 2 quarters, market liked it, and stocks was up, I don't know, whatever percent. Was up 6-7%. I mean, it closed 7% higher. I think some point of time, maybe it was up 10%. So that's on Intel. Alphabet. Let's look at Alphabet. Overall revenue is up 13%. Gosh, okay, so they were on the right side. Overall revenue is up 7%, not even 13%. It's just 7%. Operating margin is up 29% because of restructuring that they're done. Let's talk about a little bit of breakups, right? That's where, maybe come here. So Google search and others, that's bringing $42 billion. YouTube ads is higher as compared to previous quarter. Network a little lower. Overall advertising is $58 billion. About 6-7% up. Let me see what else we had. Again, you cannot, if you're a tech company and you cannot finish any earnings call without taking that word name AI. So now they announced that they brought together the part of Google research and DeepMind, Google research, which is Brainstream, and the DeepMind, the company that they acquired, to accelerate the progress in AI. So basically they're combining both the teams because these teams have a good brain power of AI experts. So now this company, this new team, it will be called Google DeepMind. Right. So if you look at their from operations side, their operating income from a Google Cloud one thing to note is Google Cloud is now actually made operating income in this quarter as compared to the loss that they had to take in the previous quarter. Number two is this whole corporate cost. It's unallocated. It jumped way higher because of this. So they moved in, they did a little bit of restructuring, and now they're reporting those numbers against corporate cost unallocated, right? And of course, all this research is a cost to the company. Overall, they still have $118 billion in cash, which is like trying to rival Berkshire Hathaway at more than $100 billion sitting in a cash, $118 billion to be precise. So from a balance sheet perspective, pretty solid balance sheet. Nothing to complain about. Overall takeaways, search was, the results were not like blowing out of water. Google Cloud was I would say of all the other stuff, Google Cloud was more impressive than the others. It grew what? Maybe I have a number. Let me just see. Yeah, it's up 28%. Right. So same stuff. Microsoft up 26%. Google Cloud is up 28%, almost on the same range. Other stuff was okay. Search was up only 4.5%. YouTube ads were up 4.4%. Other revenue, including YouTube subscription, was up 24%. So they've been focused on converting the free users to the paid users on YouTube. Number two is the losses in their other bets have reduced, right? Which is great. The big news is the CFO, Ruth Porat. She's moving into a new role of president and chief investment officer. And why not? Right? You got $118 billion to play with. They're sitting on such a huge cash. That cash could be utilized in a better way to enhance the shareholder value. And I would want, if you have such a big cash pile, yeah, it's a good position to be, CIO. And there was an interesting comment from Satya saying more than 70% of Gen AI unicorn are Google Cloud customers. Probably they give them a lot of a free. That Google Cloud customer really doesn't mean that they are all paid customers. Almost all of these big cloud providers, Microsoft, Azure, Google, they all provide free credits to startups with the hope that they will continue to stay with them when they actually become a real good businesses, right? But in this case, talking about unicorns, so I'm assuming some of those unicorns actually pay, right? So that's on Google. I was looking at a Google valuation. I think of all the three, this is still, I find this as a much more reasonably valued than Microsoft. I haven't compared that with Amazon, but looking at a cash flow, currently at about 133, 132. Let me just bring that up to see. So with the current price of 132, Google needs to grow its free cash flow to less than 7%. Less than 7%. Which is over the last, let's see what's their free cash flow have been for past few years. Cash flow. And so this is investment. So over years, I find it that growing at 6% shouldn't be an issue. The only thing is, if they decide to invest heavily in AI, then in that case, the cash flow may not grow. But that's, again, a good thing to do from a future perspective. But if they continue to run the business which they're running right now, 7% growth is not out of bounds. And that's what is being projected, I think, in the current price. So I find Google to be very reasonably priced. Again, not a financial advice, but I think I'm a happy shareholders. I don't think, even after the jump in this week, that I would want to sell my Google shares. So what is this? So they're talking about more around their whole AI stuff. So that's Google. What else? We got a couple of more companies. Unless there is any more questions. I see one question which says, if AWS and Google Cloud is up 25%, does it impact AWS? May or may not, because the market itself is growing. Right? Now, all these three companies have been growing together, right? Earlier, AWS was the only game in the town, and at that point of a time, it used to go gangbusters. But now the growth has come down. But I think overall market is still will continue to grow. Let me see if we looked at Amazon last Q1. How much did Amazon's AWS grow in Q1? So Amazon grew only 16%. Of course, its base is really, really higher as compared to others, but gone are the days when Amazon could grow at 30%. So still 16% is still okay. And gone are the days when Microsoft used to grow at 50% rate. Now they are growing at 26%. So I think that it will still grow, but the growth rate may be less. That's what I think it would be. All right, look at Enphase Energy. I know someone talk about Enphase Energy, and I looked at it specifically. Now that it has become much cheaper than where it used to be. So I was looking at what happened to Enphase Energy. Now it's almost like it used to be $400 in December, not that long ago, 7-8 months. Now it is available at less than 50%. It's even for this year, it is down 40%. But this was one of I would say, the stock that performed well maybe last year. So I heard a lot about Enphase Energy. So I spent some time to see what happened with Enphase Energy. Why did they fall down? Is it again, I have not done a deep dive into Enphase yet, but just to see what happened, right? Is it a value play, or is it a value trap? So again, if you are an Enphase shareholder, please come forward. Maybe you know more about this company and can share your views around what you feel about Enphase. I don't hold this stock in my portfolio. I've never done a deep dive. Like when I say deep dive, means the way you look at the investment thesis. I never built that for Enphase. But anyway, so looks like the revenue was lower than what they had projected, lower than the midpoint. So they were expecting some seasonally tailwinds in Q2. That really didn't work out. And then there are some challenging macro environment. One is, of course, high interest rates, means lower of course, anything if you want to finance, high interest rate will always hurt you. Lower utility prices, so that reduces the attractiveness of going solar. So California, they also passed NEM 3.0 bill in which you get a lesser credit if you are sending the electricity back to the grid, right? So they guided for Q3 substantially lower than what the Wall Street was expecting, and hence the share got punished. The reason they guided lower was that now Enphase, they don't sell directly to you and me, they sell it through the installers, right? Those who install the solar panels. Now, those installers, they are already flush with the inventory, so they don't want to, jam the channel with more and more inventory. So they're not going to sell it more, and hence they reduced their guidance for their Q3. Street didn't like it. I mean, it got punished up, down. Okay, when I took the screenshot, it was down what? It was at 154. Looks like it closed even. Yeah, no, okay. So this was 154. The lowest point was 145. Yeah. So now the question is, when I was looking at it, should I go further deep dive into it to see the company? And one thing which I could not find is, do they have a moat or not? So Enphase Energy, as I understood in my 10-15 minutes of do the earning review, they come up with those something called a micro inverters, which I think, again, I'll probably spend more time to understand how that stuff works. But they have been able to reduce the cost of them, and they are the only company that makes those micro inverters. And they've been able to reduce the cost of those micro inverters, and hence, I think over the last year, the stock had performed really well. But the bigger question is, do they have a IP? Do they have a moat around that? I don't know. Is it the product that can be commoditized? If there is no moat around the business, then I probably won't be interested in initiating anything in this one. One of the moat could be, it's a low-cost producer. There are some tech moats. There are some moat. Being a low-cost producer itself is a moat. So I need to find out more about this. If you know around Enphase, do let me know. Yeah. All right, Ramesh says, I hold it. Chinda says, compete with Solar Edge, but better product than Solar Edge. So I don't know. So there are something they're called serial inverters. Inverter and these micro inverters. I don't know. I have to figure out who does what, and does this company has a moat. The only reason I got interested is, hey, this was all rage in the news when it was like $300, $400. I heard this name a lot, many times last year, or even this year. So when this stock when I saw it at 145, 150, I'm like, what? Is this a value play now? I don't know. All right, last one is Roku. Again, Roku was up 30% after earnings. So if you're a Roku shareholder, congratulations. The revenue was up 847 million, 11%. I think the bigger, there were two reasons why the stock had such a nice pop. Was number one, first time the Roku channel was 1.1% of total US TV viewing, means their own streaming one. So we have now one more streaming channel, looks like. So I'm not sure how long, how many streaming channels we need, but looks like people are watching Roku channel. Yeah. So streaming hours were to 25.1 billion, which is up 4.4 billion year over year, which is almost 20%. Streaming hours were up 20%. So overall, I think the tailwinds are the cord cutting is still happening. It's accelerating, which is tailwind. Roku also provides prime time reach guarantee. That means, I mean, nothing is guaranteed in the world, but what they do say is they have a better reach than those cable companies, and they provide that guarantee to the advertisers, which is one thing which I'm more interested in this before I buy Roku shares is their partnership with Shopify for something called action ads. So you see an ad, and then using a Roku remote button, you can just buy it by the click of a remote, right? While you're watching a TV, you could buy the stuff on while you're watching the TV. I remember Walmart also had some similar feature. I don't know what was it, partnership with Roku or with someone else. Maybe I have to go back and check. Maybe it was Roku, but it's been more than a year or something. So yeah, so stock has done great. After earnings, it's now back close to $90. Right? This used to be, again, one of those I wouldn't call it as a meme stock, but this stock had a huge run up during 2020, 2021. This is the specific Cathy Wood stock, right? Not meme stock, but Cathy Wood stock. So Cathy Wood, it holds a substantial position in Roku. Yeah, so at some point of time, it was what, 467. Though it is up 30%, it's got a way more to catch up to get back to these previous heydays. All right, that's all around Roku. And with that, I think that's all I had for today. Do we have, I see someone joining on a number. I don't know, is that Anirudh? Number ending in 2839? Okay, no. Yeah, someone had reached out to me. They wanted to talk about, they needed some kind of a educational guidance. So I thought we can talk about it after the call. Maybe it's not here. All right. Anything else? Otherwise, that's a wrap for the day, guys. Unless you have some questions for me. Cool. All right. Looks like nothing. Well, thank you, everyone. And we'll talk again next week. Bye-bye.